Financial Analysis, Chapter 3, Lecture 2, Types of Ratios. Another thing that is important is focusing on the different types of financial ratios there are. You saw some of those on the previous lecture. The first one we're going to talk about those profitability ratios. And really they measure the firm's ability to earn adequate return on sales, assets, and invested capital. This is a list of current profitability ratios that you could use. Gross profit margin, it measures the basic profit involved in making goods or services. You can use operating profit margin, which looks at a more complete picture of profit since this includes all operating costs involved in making goods or services, even if firms have some difficulty coming up with positive net income. Net profit margin is another measurement that looks at often most reported measure of profitability, and it's the bottom line accounting defined profit margin. Return on assets is a measure of the productivity of your assets that you have, and are they generating you money? Or return on equity is another measurement. It's measuring the productivity of shareholders' investment in the firm, basically a rate of return earned on the stockholders' equity itself. Basic earning power is another measure of the productivity of assets. This time eliminating the impact of those assets or finance, such as through borrowing and paying interest. It's essentially operating income, in other words, without interest or taxes. So it's really just operating income, taking the interest and taxes out of there. Free cash flow. Free cash flow is analysts evaluating companies want to know how much a cash company is generating, especially from a solvency standpoint. When a bank might be looking at a loan, they use free cash flow a lot in terms of understanding how much cash that operation has. Asset utilization. It measures the speed at which the firm is turning over accounts receivable, inventory, and long-term assets. Asset utilization ratios. Here are some of the ratios that you'll be required to know for some homework problems and maybe a test question or two. We won't focus heavily on these ratios for the course. That is something that you could get in other courses. However, you did need to know them. It can include receivables turnover, average collection period, inventory turnover, days in inventory held, fixed asset turnover, and total asset turnover. Liquidity. It emphasizes the firm's ability to pay off short-term obligations as they come due. How easily can the asset be converted to cash? Liquidity ratios is something you will have to calculate and be able to explain within the course. A current ratio measures how a company can pay off its short-term debt with short-term assets it has available. Quick ratio is another one. It does the same thing except it takes inventory out of the mix. And it's important that you know the difference. Current ratio includes inventory. Quick ratio takes inventory out. Working capital is another one. It's another measure of what resources are available to pay short-term debt. And that is current assets minus current liabilities. So you can reference the note on ratios within OnCourse to know where these ratios are located. Debt utilization are other ratios that you will need to know for this course. It estimates the overall debt position of the firm and evaluates in the light of asset base and earning power. You need to know debt ratio, long-term debt to total capitalization, debt to equity, and times interest earned. Debt ratio is important because it helps you understand how many liabilities does the company have out there, and are they able to meet those, and are they at a good debt position based on the position the company is in the industry and compared to its competitors. That is end of Chapter 3, Lecture 2.